Welcome back to BitcoinDorks. In today's episode, we are diving into some startling trends in the digital asset market. Specifically focusing on the recent report by CoinShares about substantial outflows from the cryptocurrency space. For the fourth consecutive week, the cryptocurrency markets have experienced significant outflows, totaling $251 million this past week alone. This marks a continued trend of capital withdrawal from digital assets, signaling a cautious or bearish sentiment among investors. To understand the implications, we need to look at which assets are being hit the hardest. Typically, major cryptocurrencies like Bitcoin and Ethereum are reliable indicators of broader market sentiment. A massive outflow from these assets might suggest that investors are either taking profits off the table after recent price surges or are reacting to broader economic indicators, such as inflation rates, changes in monetary policy, or geopolitical tensions. This trend impacts the broader ecosystem, including exchanges and investment products. Products like exchange-traded funds, ETFs, and other investment vehicles that hold large amounts of cryptocurrencies are directly affected. A sustained outflow can lead to decreased liquidity and increased volatility in the prices of these assets. But what's driving this cautious approach from investors? Several factors could be at play here. Regulatory news has always been a significant driver of crypto market sentiment. Any new regulations, or even the hint of regulatory crackdowns in major markets like the US, Europe, or Asia, can prompt investors to pull back. Economic indicators are also critical. With global economies still recovering from the impacts of the pandemic and facing inflationary pressures, traditional and institutional investors might be re-evaluating their exposure to riskier assets like cryptocurrencies. The role of institutional investors in these outflows cannot be understated. Unlike retail investors, who might hold smaller amounts of crypto for longer periods, institutional investors manage large portfolios and can move the market with their decisions. Their continued withdrawal could be a sign of shifting strategies or a pivot to more traditional and possibly safer investments. Now, let's dive deeper into the broader impact of these continuous outflows on the market. Persistent withdrawals from digital assets can significantly erode investor confidence in cryptocurrencies as a viable store of value. This dwindling confidence can trigger a complex chain reaction. As more investors begin to doubt the stability and future growth potential of these assets, the market may see an increase in sell-offs, which in turn, depresses prices further. This perception of instability can become a self-fulfilling prophecy. Investors, fearing a downturn, may start to pull out, which leads to the very declines they fear, creating a bearish cycle that can affect all levels of the crypto market. This cycle can be particularly damaging as it spreads across various assets and market segments, from individual cryptocurrencies to large-scale investment products and funds. This bearish sentiment isn't confined to just the crypto markets, it has broader implications that can ripple out to affect general market sentiment across various financial sectors. When cryptocurrencies exhibit such volatility and investors respond by pulling back, it sends ripples through the entire investment community. This cautious approach can substantially influence the strategies of institutional investors and financial firms that might otherwise consider diversifying their portfolios by incorporating digital assets as a means of modernizing investment strategies and achieving higher returns. The impact of these market dynamics is profound. Both retail and institutional investors may grow more cautious, scrutinizing their investment decisions more rigorously in light of the increased volatility and uncertainty in the crypto markets. As a result, there could be a significant shift in investment flows, with money being redirected towards traditional and perceived safer assets like government bonds, gold, or even real estate. Such a shift not only affects the liquidity available in the crypto markets but also alters the fundamental strategies used by investment managers worldwide. This shift in sentiment and strategy can profoundly influence other related areas, such as venture capital funding for blockchain startups, innovation in financial technology, and the adoption of blockchain solutions across various industries. Venture capitalists and other investors often gauge the health of the blockchain ecosystem by the performance and stability of cryptocurrencies. As enthusiasm for crypto investments wanes, venture capital might become more hesitant to fund blockchain projects, fearing a lower return on investment or a less enthusiastic market for new technologies. This reduction in funding could have several consequences. First, it might discourage entrepreneurs from launching innovative projects that could advance the sector, thereby stalling the development of new technologies that could revolutionize industries from finance to supply chain management. Moreover, existing startups that rely on continuous funding rounds might find it challenging to secure the necessary capital to scale operations or advance to their next development phase. The slowdown in venture capital funding could also affect broader innovation in financial technology. Many fintech startups are heavily reliant on blockchain technologies to disrupt traditional sectors such as banking, insurance, and real estate. A decrease in investment could not only curb innovation but also slow the pace at which blockchain technologies are integrated into these sectors. The general slowdown in the sector due to decreased funding could lead to reduced adoption rates of blockchain solutions. Industries that might benefit from blockchain technology, such as healthcare for secure patient records management, or logistics for enhanced supply chain transparency, might delay or reconsider implementing such solutions. This cautious approach could slow the overall progress in achieving widespread blockchain integration and delay the realization of its full potential across various fields. In conclusion, while the report from CoinShares on the $251 million outflows for the fourth straight week might seem concerning, it also opens up various narratives and strategies for different types of investors. Whether this trend is a signal of a major shift in the crypto space or a temporary retreat due to broader economic conditions remains to be seen. That's it for today's discussion. See you in the next video.